We're going to keep it simple. What recession, especially given that payrolls number that actually came in fairly strong, beating some of those estimates? Let's ask our next markets guest here, Dominique Dwor-Frecaut, Macro Hive Senior Strategist. Thank you, as always, for joining us. Let's start there. You have data this week that's actually been quite strong. ISM data, the payrolls data. At the same time, sentiment is at decades low, but the spending data out of the United States remains fairly strong. There's divergences in what this economy is telling us. So let's start there. What recession?
So I'm totally with you. There's no sign of impending recession. I think what's going to be needed for a recession and what's coming is a much higher Fed funds, a much tougher Fed than we currently have. So on current trends, totally with you, no sign of recession.
You, last time I spoke to you, suggested that the Fed is going to have to go as high as 8%. Are you still of that view?
Definitely, especially with the data we got today. Basically, what we are seeing is the development of a wage price spiral, which is not surprising because, you know, when inflation is, depending on how you measure it, between 6 to 9%, behaviors change. Workers, you are talking about the sticker shock of, filling your tank. Workers want to be compensated for that. It's super hard to find workers, so employers are going to raise wages. In fact, there is already anecdotal evidence that wage reviews have been brought forward because employers are worried about losing their workers. So in my view, the wage price spiral is already there. It's only going to get stronger, and once those wage price spiral are established, it becomes very tough, very costly in terms of output and employment to bring down inflation. And in my view, that's where we are headed.
Dominique, let's talk about that labor dynamic there, because at the same time as we see payrolls added, you also have some of America's biggest companies actually laying off workers. Tesla, Amazon, even GameStop, for example, in the last 24 hours announcing that they have widespread layoffs as well. I'm curious, at what point do this rising commodity costs, rising input costs, transportation costs start to mean that people can't actually afford the workers that they so desperately need?
Well, I mean, obviously, we are not there yet. The layoffs are happening in sectors that were overvalued. I mean, we've had an extended period of very low interest rates, and we are moving towards a regime of a higher interest rate. And when that sort of transition happens, you always have a bit of a disruption, a bit of the cleanup of the financial imbalances that were built during the period of low rates. So tech definitely was overvalued. Shareholders have been subsidizing the rides of Uber customers. So that has to stop. And so you have some job losses in those sectors. But look at the data today. It speaks for itself.
Yep. Dominique, if the Russians turn off the gas to Europe and the Eurozone goes into a very sharp recession as a result of that, can the Fed go to 8%?
So 8%, no one knows what the Fed funds rate will be 2 years from now. I am saying it's going to be much higher than the 4% the Fed has penciled it. For sure, it may be 7%, perhaps even 6, definitely above 6. And for sure, if you have a worldwide recession, the dollar is going to appreciate. This will shave off inflation, shave off growth, and it will impact Fed policies. There's no question about it. But the bottom line is that with the sort of homeopathic tightening that is penciled in right now, we're not going to bring down inflation.
Okay. On that note, we will leave it. Dominique, thank you very much indeed. Dominique Dwor-Frecaut, Macro Hive Senior Strategist. Thank you very much indeed.